Okay, so you want to own a supermarket. Find a building, stock the shelves, watch the carts roll through the checkout lanes. Thousands of customers a week, hundreds of dollars a cart, money pouring in from the moment the automatic doors slide open. Sounds like one of the safest businesses in the world, right? Food is the one thing people can never stop buying. And there's one specific thing about how this business actually makes money that almost nobody, including most people who already own one, fully understands. I'll get to that at the end, and when I do, it's going to completely change how you look at every grocery store you've ever walked into. But first, let's talk about what you're actually buying into. The average American supermarket brings in around $711,000 a week in sales. That's roughly $37 million a year from a single building in a single town. Walk into any of the nearly 58,000 supermarkets across the country, and you're looking at an average of almost 32,000 individual products sitting on those shelves. The checkout lanes never really stop moving. The revenue numbers feel like proof that this is a great business. And that feeling is exactly what gets people into trouble. Grocery store profit margins are among the thinnest in all of retail and in all of American business. The average net profit margin runs between 1% and 3% of revenue, a range so narrow that a single bad quarter of shrinkage, spoilage, or supply chain disruption can push a profitable store into the red. FMI's latest benchmarks put the average net profit for food retailers at 1.7% in 2024. Run the math on that $37 million in revenue, and the store keeps around $629,000 a year. When a customer spends $100 at the register, the owner walks away with less than $2 of it. Everyone else in the transaction, the manufacturer, the distributor, the trucking company, the landlord, the employees, the electric company, takes the rest. So before you think about buying a grocery store, you need to throw out the mental model you walked in with. This is not a markup business. Nobody gets rich charging a 50% premium on a can of soup. This is a logistics operation wearing a retail costume. The real skill is moving enormous volumes of perishable, low-margin goods through a building faster than they spoil, faster than they get stolen, and faster than a competitor 2 miles away can undercut you. Understand that, and everything else about this business starts to make sense. Let's start with what it actually costs to get in the door, because most people dramatically underestimate it. Opening a grocery store in 2026 requires $80,000 to $300,000 for a small neighborhood market, and a mid-size independent store with proper refrigeration, full shelving, and adequate inventory typically runs $300,000 to $700,000 before opening day. Full-scale supermarkets in prime locations push well past $1 million. And that's before you've sold a single item. A full-service supermarket will need $150,000 or more just for opening stock alone. The cost for vital equipment, refrigeration units, shelving, display cases, and checkout counters generally runs $100,000 to $300,000 on its own. And then there's the building. Retail rents in U.S. shopping centers have reached an average of $23.98 per square foot. The average grocery store measures about 35,800 square feet. Do that math, and you're looking at a rent bill that can hit $850,000 a year before you've turned the lights on. Most independent grocery stores take 18 to 39 months to reach true profitability, because thin margins mean fixed costs must be covered on volume, and volume takes time to build. So the entry cost is steep, the margins are razor thin, and the runway to profitability is long. That's the baseline. Now here's where it gets interesting, because there are things happening inside a grocery store's finances that most people, including most shoppers, have never heard of. And the first one is going to sound a little absurd. Many grocers make more profit from a product sitting on the shelf than from actually selling it to you. This is called a slotting fee, and it's one of the most quietly powerful mechanisms in all of retail. Manufacturers pay retailers for the right to occupy premium shelf space. Eye level, end caps, the first thing you see when you turn down an aisle. And those fees are not small. Slotting costs run roughly $250 to $1,000 per item per store, which aggregates to $5,000 to $20,000 or more per product across a full chain or region. That's a cost structure that functions almost like a listing fee on a stock exchange, except most consumers have never heard the term. And here's the part that really reframes it. These allowances average around 17% of gross manufacturer revenue, meaning the shelf itself is a rentable asset, completely separate from the groceries sitting on it. The grocer is essentially a landlord twice over, once for the physical building, and again for every inch of shelf space inside it. So you've got slotting fees coming in from manufacturers before a single item sells. But manufacturers are also paying a second, hidden tax on top of that. One that never shows up on your receipt. It's called trade spend, and it covers promotions, off-invoice discounts, and scanned-down allowances that the retailer takes whether the supplier formally agreed to them or not. Trade spend runs 15% to 25% of gross wholesale revenue, clustering around 18% to 20% for established grocery brands. On roughly $3 of gross wholesale revenue, about 55 cents disappears before cost of goods is even counted. That means the manufacturer is funding your store's promotional calendar, your circular ads, your buy one get one deals, and paying for the privilege of being stocked in the first place. This is why getting a new product onto shelves nationally can cost $20,000 or more before a single unit sells. And it's why big established brands have a structural advantage that has nothing to do with whether their product is actually better. They can afford the entry fee. Most small producers can't. Now, remember that open question I planted at the start? The thing about how this business actually makes money that almost nobody fully understands? We're getting close, but first, I need to walk you through the part of this business that is quietly destroying more grocery stores than anything else. Shrink. In the grocery world, shrink is the catch-all term for inventory that disappears before it can be sold. Spoiled produce, expired dairy, broken bottles, and yes, theft. The average grocery store loses $40,000 in profit every single month to shrinkage. That's nearly $500,000 a year. Gone. In a business where the entire annual profit might only be $629,000. So shrink isn't a line item. It's an existential threat. And here's the part that surprises most people. 64% of store shrink is directly caused by a breakdown in or absence of effective operating best practices, not theft. The theft narrative gets the headlines, but internal chaos is doing most of the damage. Misplaced stock, poor receiving processes, inaccurate counts. In fact, an average of 60% of items believed to be out of stock are actually just misplaced somewhere in the store or the back room. The product is there. The store just doesn't know where it is. So what did the industry do about this? It installed self-checkout machines. Sold as a labor cost-cutting innovation, self-checkout was supposed to trim the wage bill and let the math work out. Here's what actually happened. Self-checkout machines drive losses amounting to 3.5% of sales, more than 16 times higher than the loss rate in traditional cashier lanes. The mechanism is something called partial shrink, where a shopper scans some items, but not all of them. Maybe it's intentional. Maybe the machine missed a barcode. Either way, the store saves on wages and loses more on theft than it saved. Despite representing less than 30% of transactions in 2022, self-checkout was responsible for over $10 billion in lost profits for food retailers nationwide. And given a 1.7% net margin, that single technology decision can be the difference between a profitable store and an unprofitable one. The store tried to solve a cost problem and accidentally created a bigger one. That's the grocery business in a nutshell. Every optimization has a hidden downside, and the margins are thin enough that the downside always matters. Now, there's one more layer to this business that almost nobody outside the industry talks about, and this is the one I promised you at the start. This is the thing that changes how you see every grocery store you've ever walked into. The most profitable part of a modern supermarket isn't groceries at all. It's selling your shopping data to advertisers. Here's how it works. You sign up for a loyalty card to get 10 cents off a box of cereal. The store gets something far more valuable in return. A complete, time-stamped record of everything you buy, how often, in what combinations, and how your habits shift over time. That data is then sold to brands and advertisers through what the industry calls retail media networks. And the economics of this are staggering. A retailer generating £100 million in retail media revenue at a 65% margin adds the same operating profit as £1.6 billion in incremental grocery sales at a 4% margin. Read that again. 100 million in data revenue equals 1.6 billion in grocery sales. Tesco's Club Card alone reaches 86% of UK households and touches 84% of all Tesco transactions. The card that gets you 10p off milk is quietly one of the most valuable data assets in retail. This is why the biggest grocery chains are investing so aggressively in loyalty programs. Not because they care about giving you discounts, because the data those programs generate is worth more than the groceries themselves. The store you thought was selling you food is also in the advertising business, the data business, the real estate business, and the shelf rental business, all at the same time. And speaking of real estate, here's one more thing that's worth knowing if you ever consider buying a grocery-anchored property rather than the store itself. The grocery anchor, the store that draws the entire shopping center's foot traffic, often pays the cheapest rent per square foot in the whole complex. Anchor tenants pay 5% to 10% less than the standard rental rate because a strong grocery anchor generates the foot traffic that subsidizes every smaller shop around it. The business that draws the crowd gets the discount. The smaller shops riding that traffic pay more. So the grocery store is simultaneously a tenant paying below market rent and the reason every other tenant can charge above market prices. And if you're an investor trying to evaluate one of those properties, good luck getting the information you actually need. If a grocery anchor has a new location opening within a mile or two, investors worry the chain may quietly decommission the old store. But grocery chains have large real estate departments whose job is to maintain negotiating power. And they typically won't give outside investors the cannibalization data they need to assess that risk. The store's own expansion plans are treated as a trade secret, even from the landlords whose entire property value depends on that store staying open. So let's bring this all the way back to where we started. You wanted to own a supermarket. You pictured the carts, the revenue, the steady flow of customers who will always need to eat, and all of that is real. The average supermarket does pull in around $37 million a year in gross sales. The foot traffic is real. The demand is real. But the business underneath that foot traffic is something most people never see. The shelf is a rentable asset that earns money before a single item sells. The gross margin that looks like profit, that 24% to 30%, gets almost entirely consumed by labor, occupancy, and shrink before $1 of net profit appears. The technology installed to cut costs quietly multiplied theft losses by more than 16 times. The internal operating chaos costs more than shoplifting ever did. And the most profitable revenue stream in the whole operation isn't groceries. It's the data you hand over every time you swipe your loyalty card at the register. This is a business that rewards obsessive operational discipline and punishes every assumption. The margin is so narrow that a single bad quarter of shrinkage, spoilage, or supply chain disruption can push a profitable store into the red. At these margins, operational discipline isn't a competitive advantage. It is a survival requirement. The people who win in this industry aren't the ones who love food. They're the ones who love systems. They're the ones who understand that the store is just the surface, and the real business is everything happening underneath it. If this breakdown surprised you, there's a good chance our video on how Walmart quietly became the most powerful grocery operation in America will too. The pricing strategy they use makes everything we just talked about look simple. That one's worth watching next. And if you want more of this kind of deep dive into how industries actually work behind the scenes, subscribe. We do this every week. Drop a comment below and tell me, did you already know about slotting fees? Or did that one catch you off guard? Because every time we post this kind of video, that's the one that gets people the most.